5 Roth conversion mistakes. You guys know we love Roth accounts. It's the #1 account type that we have at Directed IRA. We have more Roth IRA accounts than any other account type. And there's a reason: tax-free wealth.
Welcome, everybody, to the Directed IRA podcast. Excited to have you here. My name is Mark Kohler. I'm with the author of the Self-Directed IRA Handbook, Matt Sorensen, who, lucky as we are, and chance may have, is also the co-host. So the best-selling book on this topic is the co-host of the show with me, or am I with you? Either way, we're here together.
We're just together, guys. You know?
We're just going to rock it.
Yeah, and this is a cool topic today. I was excited for this topic. 5 Roth conversion mistakes. You guys know we love Roth accounts. It's the #1 account type that we have at Directed IRA. We have more Roth IRA accounts than any other account type. And there's a reason: tax-free wealth. We love building and growing tax-free wealth. Many self-directed investors know it. We want that money coming out totally tax-free at retirement. But many people have traditional accounts, and they need to convert to get over there. I want to talk about that process in general. And then we're going to hit the 5 mistakes people make, because people can screw it up.
Well, and I don't know if this is the show for the process, because the process could be a whole show in of itself. But I think if we hit these 5 mistakes, we're going to kind of unpack some of that.
Let me just say this. If you're converting from traditional to Roth, you have to do a written election, and you're going to get taxed on that. If you want to convert $100,000, we're going to send you a 1099, and you're going to get taxed on that. I want to make sure people understand that there is a cost to convert.
No penalty.
Yeah.
But you're going to pay tax of whatever marginal bracket you're in. Meaning, if I made $10 more next month in a side hustle, what tax rate would you be in? State and Fed. Well, same thing when you convert to Roth. What's that next dollar of tax going to look like? Now, we will say this again. A lot of people ask me too. They're like, Mark, you've done 10,000 consultations with clients over your career. What's the trick? What do wealthy people do? I've got 3 or 4 things. I'll tell you right now. They have Roth. They have Roth money, and they try to create as much Roth wealth as they can. That's what wealthy people do, because they know it's a lot easier to invest money that I'm never going to get taxed on. At age 59 and a half, I've got an ATM. I can pull money out any day of the week, tax-free. And 59 and a half comes a lot faster than you realize. So it's just that's what wealthy people do.
Yeah.
So if you please pay attention.
Yeah. Yeah. So if you've been sitting in traditional and you're like, I know I need to get to Roth, you've got to make the Roth conversion, but we want to make sure that you do not get caught up in some of these 5 mistakes people make.
Yep. Oh, and one other thing. Some of you go, well, this is just for the entrepreneurs. They have more latitude and more autonomy to do what they want. No, this is for all of you that have a day job at a Fortune 500, 1,000, 5,000, whatever. If you have a day job with a 401k, you can do Roth conversions too.
Exactly.
You can do that Roth conversion inside your 401k, and you don't have to quit employment. There's no penalty. It's going to be a very, very easy process. So this is for everybody, young and old. And I even have 70-year-olds that are like, should I convert to Roth? Yes, because when your family inherits that Roth, they're not going to pay tax for 10 years and continue to invest it. Mm-hmm. A Roth is the best, hands down, day of the week, and twice on Sunday. So trust us on that. And we've got show after show elaborating on that. Okay, now the 5 mistakes. We bought you in. You're on this. You're bought in on this. We got you. Now here's 5 mistakes not to do in this process. We're going to keep it tight, right to the point.
All right. Mistake number 1, doing it all in 1 year. Don't
get greedy.
Yeah, don't get greedy. You can do that, and some people do that, but doing it all in 1 year rather than chunking it. We've talked about the chunking process. I love doing this process. We love recommending it to clients. Essentially what we're saying here is, let's say you have $100,000 you really want to convert to Roth. Rather than doing $100,000 in that same year and getting a 1099 for 1 year for $100,000 that's going on in 1 year's tax return, why don't we break that up into 2 or 3? Give me 2 1099s, one in 2023, one in 2024, each $50,000 each. Or maybe I can do it in over 3 years,
pieces.
Whatever, however you want to break it up. So that's tip number 1, is going all in, which we love. I mean, I like that, but maybe being a little more strategic about it to keep your tax burden down.
Yeah, and here's the strategy. And Robbie, my marketing director, I want to make sure it's tight, please, is our chunking Roth video on YouTube. Maybe it's one I need to update. I think it's pretty tight right now. But I go through a whiteboard. You're going, well, what's the strategy? The strategy is looking at your break points of when you go into another tax bracket. When you hit that next tax bracket, and there's 2 tax bracket jumps of 8% or more. or of 8%. And so if we're just going to jump up a 2 or 3% bracket, let's chunk away. But if it's going to pop you up 8% in tax, stop. Wait till next year. Let's chunk again. So there's a strategy of finding the right amount based on your other income. And we're going to come to the timing of this. That's one of the other mistakes. But be thinking about the bracket you're in and chunking in pieces, not doing it all at once. And last point, you can have any income level. You can do this at any income. Don't worry about some advisor going, you can't have a Roth. You make too much money. Not in the chunking conversion realm. There's no income limits.
Yeah. That was a rule 10 years ago that's since gone out the window. That Congress changed that. So you can convert at any age. All right, now here's
number 2.
Mistake number 2. Paying tax out of the traditional account when you convert to Roth. For example, let's say you've got a $100,000 traditional IRA. You're like, well, I want to convert that, but I want to use the money in my retirement account to pay the taxes. Now, this is one of the cringiest things in directed IRA I see people do. Okay, you want to pay the tax on that. So you're in a 30% tax bracket, let's say. By the way, you're not 59.5, so taking that distribution out is a 10% penalty on top of it. What are you going to have left? A $60,000 Roth IRA? You've taken all this money off the table that could be in your Roth because you didn't want to personally pay the tax. You wanted to drain the retirement account to use the money to pay the tax for the conversion. Do not do that.
No, and let me give the math of what Matt's saying a little slower. Some of you might be driving here. You have $100,000 in that traditional account. You look to call your accountant and they go, okay, yeah, you could convert X dollars between state and Fed, a good break point. You could convert the whole 100. It's not going to drive you into a major bracket, but it'll be 30%. So you go, okay, 30% of $100,000 is 30,000. Well, you look over at your personal bank account and go, I don't have $30,000. Okay, I'll take a distribution from my IRA for $30,000, then convert. But but I can't convert the whole 100 because I'm going to take out 30. Yeah. So I'm only going to convert 70 and then take that 30 personally, which is another 1099 next year, by the way, and subject to a 10% penalty. Yeah. So now you got to pay tax on the 30 as well as the conversion amount. And so...
And then penalty on the 30. And there's no penalty on the conversion, but there's a penalty on the distribution.
And so you start this snowball, which we love the word debt snowball, getting out of debt, but we do not like this taking money out of an IRA to pay the tax on a conversion because it creates another taxable event a year from now. So don't do that. And that's why chunking is good. Because you can say, all right, my grandma left me 10 grand, or I sold this rental property and I've got an extra 20. Rather than put that 20 in savings, pay the tax on a conversion because it's effectively improving your savings position. Did you hear me, everybody? You may say, well, Mark, you just told me to pay tax with 20 grand rather than put it in savings. Yeah, because when you pay the tax on the conversion, you've just enhanced your savings account inside your Roth as if you did put 20 away, because you'll never pay tax again. It's very deceptive, but it's so powerful.
Yeah, you're banking on the long run here. That's the thing with the Roth conversion. It's a little pain right now, but no pain, no gain. In the Roth account, the deal is you get to keep it all. When you start pulling it out, like Mark said, the tax-free ATM, when you hit 59.5, you want to pull money out? Cool, no taxes. If you keep riding on that traditional account, you hit 59.5, you want to start pulling on it? Okay, the IRS is going to have their hand out. You want to take a $100,000 distribution? You're actually going to take a $60,000 distribution because the feds are going to want 30% and your state's going to want 10 or whatever state tax bracket you're in. But in the Roth, you don't need to worry about that. Nope. It's all going to you. So you're banking on the long run there, but don't be paying tax on the money converting. Find a way to do it out. I've even had clients be like, if I have to get on a payment plan with the IRS to figure this out and pay it off, so be it.
That's better to do that.
That's better than paying the penalty, frankly, on the amount you distribute.
Yeah, and we're going to come to the timing, but you actually do the conversion now, anytime in 2023, you're actually not paying the tax until April. So it does give you time to sell some assets. Maybe that crappy RV on the side of your house needs to go, and that pays for your Roth conversion. I don't know, find the money. You've got maybe a few months or more to really get that money saved up. And like Matt said too, maybe you do get on a payment plan with the IRS or pay a few penalties to pay that tax next summer. It's not going to be the end of the world. It's cheaper than a credit card. So there's a lot of ways to get that conversion paid for, but be very calculated. Okay, number 3.
All right, number 3. This is a tough one because I've been guilty of this, and I'm going to make a little.
You're going to confess here something?
I'm going to make it's a little confession, but I am going to make a commitment.
Okay.
Here, okay, all right. Assuming this is the mistake. Assuming you're going to make less money next year, and that's the year you're going to convert. Guys, I've been doing. I mean, I don't want to talk about what I'm making, but I'm just saying I've been making that excuse for 10 years now. Like, well, I'm just going to convert next year because I have some traditional dollars. Okay, I have Roth, but I've got a lot of traditional dollars, and I'm a little ashamed of it. No, but I've been like, so what I'm going to do, I'm actually going to chunk it over 2 years. Okay, end of December here in 2023, I'm going to convert half of what I have left in traditional, and in January of 2024, I'm going to convert the other half. That way, I'm chunking it over 2 years. It's easy. It's clean. I can break it out into 2 years and just freaking get her done. And don't get stuck into this trap. It's so common. Everybody's like, I agree. I love the Roth. I've got some Roth, but I don't want to convert all my traditional. I just can't. I don't want to have to do the tax, and I'll make less money next year. Maybe the economy's going to go down or whatever, and then that just never happens.
Yep. Okay. Now here is a great way to deal with that issue. You can actually make a Roth conversion tax neutral by doing a little planning. Any of you that are like, my income, my tax, I'm in the highest bracket anyway, Mark. There is no break point. There is no chunking opportunity because I make too much money already, or I'm in the worst bracket. Do some advanced planning. Meet with one of our tax lawyers. For example, I'm doing a Roth conversion this year, tax neutral. You can invest in an intangible drilling cost deduction. That's an oil exploratory well investment. There's syndications out there. We had a speaker at our Tax 360 conference in Salt Lake 2 weeks ago. Michael Maselli, incredible. They're everywhere. These IDC investments in oil and gas have an offsetting dollar for dollar tax deduction. So if I can create a deduction, so if I have $100,000 over here that I was going to invest anyway, I can put that in an IDC, convert $100,000 in Roth, tax neutral. I could also do an Airbnb strategy. I could do a buy into a rental property. Maybe I'm working on a self-rental in my business. I could do a cost segregation analysis on either one, and I don't have to be a real estate professional. So now I can make that Roth conversion tax neutral while making a good investment at the same time. Yeah. So there's so much advanced, and we could talk charitable trust, we could talk all sorts of strategies. So please have an advanced planning meeting. And if your own accountant doesn't get this, schedule one with one of our tax lawyers. Get to kkoslawyers.com. Schedule an hour. People are like, Mark, I'll pay you anything because I know if I pay you $1,000, you're going to save me 10 times that. And we have an incredible team, many Marks, many Matts, that can do some advanced planning with this and make that conversion neutral.
Yes, yeah, that's the plutonium right there, because there are strategies of where you can just offset that. You don't have to pay the tax.
Yeah.
Use one of these tax strategies. It doesn't work for everyone, but for a lot of you business owners and real estate investors, it can work. All right.
Number four.
Mistakenly thinking the deadline is April 15th. So many have got that deadline stuck on our head. It's when our taxes are due. It's the IRA contribution deadline.
I can't convert up until April 15th for last year?
You cannot. You can convert on April 15th, 2023 for 2023. Okay, so always this happens. We get people throwing in Roth conversions in April 14th, April 15th. And like, did I make the deadline? Did I make the deadline? Did you get it? Did you convert it? I want to make sure. We're like, yeah, but it's for 2023. Well, I thought, no, the deadline for Roth conversion for what tax year you want it in is December 31st. So if you want to do, let's say, a 2023 Roth conversion, do it by December 31st, 2023. April 15th has nothing to do with Roth conversions. It does matter for your contributions, and yes, you can make your contributions for 2023 by April 15th, 2024, but the Roth conversion deadline is December 31st. So make sure, particularly where you're planning on this tax issue and the chunking and what year to get it in, make sure you're keyed in on that deadline.
I love it. And here is the quandary to feel your pain point is we wish it was all April 15th because by then you know what tax bracket you're in.
Right.
And so nice. I know it's hard. So you're calling your accountant in November, December going, what bracket am I in? Well, I don't know. I haven't even ran a return for you yet. In fact, the IRS hasn't released tables for this year or my software isn't ready for you. So you have to do some math, look at your last year's tax return, changes in your income or expenses, kind of ballpark it. So it is a little subjective, but that's okay. You can still survive. So this is why at our law firm, we are swamped in November and December. If any of you are already planning to have this conversation in the fourth quarter, schedule your appointment now. This is like game on, because December 31st is the deadline. And so don't wait to get that conversation.
Yeah. Get ready. No, actually, sorry. Be ready so you don't have to get ready. All right.
Ooh,
so
I like
act
that.
now.
Okay.
Act now.
Number 5.
Okay. Number 5. And this is Mark and I were kind of talking through this, and this is kind of once you're going to do it, okay, you've decided, all right, I'm going to do this, making sure you understand there are some steps in the process. It's not just hit the easy button. All right.
Yeah. Just text someone 3978 to this number.
Yeah. And we've seen it with clients over the years. They're like, okay, all right, I want to do a Roth conversion. Okay. You need a Roth account. Do you have a Roth account yet? Because if you just have a traditional, you fill out the Roth conversion form, there's nothing to put it into. You need a Roth account, and there's different account forms. The IRS requires different disclosures and things on that, and it's a separate account from your traditional. So if you're chunking too, where you're converting just a piece of the traditional Roth, realize you're going to have 2 accounts for a while. You're still going to have that traditional money, and you're going to have the Roth account with the Roth money.
Oh, and I came up with number 6.
Ooh,
we're going to go
a
6.
Bonus.
I've got a bonus.
Because I like to bring the 5 with a bonus.
Okay, I got a bonus for you here in a moment. So on this, I do want to add a little color commentary that if I just went through this, I told Matt how we came up with number 5 is I had a Acorns and a TD Ameritrade Roth conversion this last 3 months. I had to work through both of them with family, and they were kind of a pain in the butt. So what we've tried to do at Directed IRA is streamline this for you, because obviously you want to invest in what you know anyway. Why are you going to do a Roth conversion to buy more Tesla stock? We have a Directed IRA. We have a helpline. It pops right up, and you call that number or start a chat. We're going to give you the steps. You tell us your situation. We will help you through it. I even myself called my own hotline. Yeah. I go, I'm a tax lawyer. I want a chunk. I'm the part owner in the company. And I was like, but I don't do this every day.
Yeah.
If you're not in the trenches on the paperwork between these big companies and banks, it can be a pain in the butt. So the mistake is thinking there's an easy button. But call the hotline. Go, you know what? I want to self-direct anyway. We have a one-form process that creates a traditional, converts to Roth, or if you may already have a Roth with us, you may need there's 4 or 5 different variations. Like I said, that's a whole other show on how to do it. But the easy answer is call the number on the website at Directed IRA, say I want to convert, and if you're not sure how much, that's when you call KKOS and get that appointment at the same time. So you can do this very strategically. It's painless, but you do have to get engaged.
Yeah. So love that. We have actually what's called a Roth conversion account app at Directed that opens up a traditional here where we'll get your rollover from whether it's Acorns or TD Ameritrade or Fidelity. It opens up a Roth account in the same process, and it does the Roth conversion all in one. Now, if you're chunking, you got to be strategic about how you're doing that and make sure that whoever you work with understands that, so they only do a partial conversion instead of converting the full thing. So, and you can do that too if you're like, guys, I'm just going to leave my traditional over here in the stock market, but I want to, it's got a couple $100,000 in it, but I want to get over $100,000. I want to start self-directing, and I'm going to do Roth. So you can partially convert too. You don't have to move the whole thing to Directed or convert the whole thing. You can do this in pieces too.
I love it. Okay, brave for bonus?
Yes, let's hear it. I'm curious.
You're going to love this.
I like it.
The bonus mistake people make is they think, oh, my Directed account is in real estate. I can't convert because I don't have cash to convert. I've got a real estate holding. Oh, you can still convert. You can still convert if you have hard assets in a self-directed account. Matt, tell them the solution.
I love it.
Dude, you like my bonus? Bam, straight.
You can convert. It's called an in-kind conversion. But what you're going to need is an appraisal of the asset. So if it's a property, just go get an appraisal.
Can you do a BPO?
We prefer an appraisal.
Okay.
That's a gray area.
Okay.
And you should, a BPO is a little cheaper, but you're going to want an appraisal for your own sake. We require it.
And it could be a note, raw land, rental property, gold, silver, whatever. You need someone to verify what the value is.
And it's got to be a third party. Yeah. Real estate's the most common because everyone's familiar with getting an appraisal. There's people that have that job that do real estate appraisals. Yeah. What I've seen a lot of people do, especially if your retirement account just bought this and it's a traditional account, go back to who did the appraisal when you bought it. And just tell them to update it.
Yep.
You know what I mean? It's easy. They got a lot of the work already done. And And usually you can get a discount on that. But get an up-to-date appraisal. So if that appraisal says the property's worth $250,000,
and there's a loan of $150,000.
okay, we're going to net that out because you really have $100,000 of value in the account.
So my LLC held by my Roth is worth $100,000.
Yep. Now maybe you got a checking account in the LLC with $10,000 in it. So we're going to add that in, because we want that bank statement. We're going to add that in. That would be $110,000 if you had a checking account. If you're owning it directly in your Roth, we already know the cash sitting.
And let's say I want to convert $11,000. What do you do?
11,000 of the 110?
Yeah, I don't want to convert the whole 110. I'm going to chunk.
You can chunk, I guess, in that, but that's going to take you.
But then I have a Roth IRA.
Yeah.
Okay, say I want to do more. I was just trying to give you. I was trying to give you some easy math because you're going to deed how many units.
Like, if you really called me and said I got 110,000 of value and I want to just convert 11,000, I'm going to be like, why? That's not worth the hassle. But let's say it's half.
Let's say it's $1,000,001.
Okay,
right? I'm just trying to say.
I'm gonna do 100,000.
Yeah,
yeah. I get.
Okay, see where I was going with all this now?
I just, people sometimes, run with what we're saying sometimes.
So but I don't transfer cash to my
Now
new Roth.
you can do that. You can chunk it, even in kind, and you're going to have a traditional Roth that owns that LLC if you have an IRA LLC, or that owns the property based on those percentages. It's not a prohibited transaction or anything to do this because it's splitting up the ownership based on a Roth conversion. Now, it gets a little complicated because now that LLC is a partnership, and you might have to start filing a tax return. You will have to start filing a tax return on the LLC. And now if you start chunking every year, you need to update the appraisal every year.
Okay, all right. Let me help you out here. Matt is so smart. You gloss over some things sometimes. So what I was trying to set up for all of you, let's go back to your math. So people driving down the road, you got a Roth IRA with an LLC and a little rental in there. You get your appraisal, it's worth $250. Your mortgage is $150.
You can have a traditional IRA.
Yeah. So thank you. This is good. So I have a traditional IRA. I have a traditional IRA LLC with a little rental in it.
Okay.
I get my appraisal. It's worth $250.
Okay.
I have a mortgage of $160. So I have net value of $90,000 in the property.
Okay.
But Matt said I've got a $10,000 in the bank account in that little LLC. So what is the value of that LLC owned by my traditional? $100,000.
Yep.
Now add zeros to it, whatever.
Yep.
But you say I can't convert the whole $100,000. I just want to convert half of it. Okay, so I'm going to convert half of that LLC to Roth. Well, where do I send the money? Well, there's no money. This is the step. You're going to transfer 50 units of the LLC to a new Roth IRA, and now your Roth IRA owns 50 units of the LLC, and your traditional is left with the other 50 units. You'll pay tax on the $50,000, which we've already talked about. You have till April to do that. But now you have an LLC owned by Roth and traditional. Now, let's say you were really strategic. You got that appraisal in December of this year. Oh, that appraisal is going to be good for approximately 90 days. So now we can turn around and do the other chunk in January and not have to do another appraisal. So now I've chunked this LLC 50% in December, 50% in January, and I do another membership transfer agreement in this in-kind transfer form that's a directed IRA. And so within 60 days, you've converted everything, put it in 2 different tax years, and you did it all with an LLC. That, I think, is incredible. It's a neat opportunity.
Yes.
Because as the property goes up in value,
now it's
you
all
just
Roth.
froze it.
Yeah. Now you stuck it right there. The IRS isn't getting any more than what the value is right now. All that growth and stuff that's going to happen, it's going to come out totally tax-free to you. So
I like to call that a Roth freeze. I like Dairy Queen, so I got to get the tasty freeze.
Yeah.
I call it a Roth freeze because let's say you know that rental property is going to be going up in value. There's a new development going down the street and maybe on the outskirts of an opportunity zone. Maybe you go to that appraiser and go, dude, I need this as low as possible. Okay, all right, I can come in at 200 on this reasonably. All right, sign off. Boom. Now, 6 months later from now, you know it's worth 250 or 3. Boom, you just froze it and only pay tax on 200. Bam.
There you go. Freaking love it.
That's a bonus, baby.
Yeah. So for any of you that are self-directing with traditional accounts, that's an awesome strategy to know. You still can convert to Roth. There's some process in there. You heard it takes some appraisals and some transfer of ownership, but it's possible. And when I was going back on the prior one for myself, this is the reason I'm doing it over December and January over 2 years. This is I have some in-kind stuff I'm going to have to do. So,
and we got to get a tax-neutral scenario. I'm meeting with Michael. We're looking at IDCs.
Okay.
There's some
Okay.
good stuff out there. We got to get
Okay.
some write-offs for you.
Okay. All right.
Because I know you're a saver.
I'm thinking the self-rental for at least some of the 2024 thing. Because we're on the cusp of some stuff for
Yeah,
some
that's
office
right.
building stuff.
We love the self-rental. Another topic.
Yeah.
Get over to our Main Street podcast, folks. If you haven't got to Main Street podcast, mainstreetbusinesspodcast.com, or just search Main Street on your portal. We've got all sorts of shows on some of these investment and tax strategies that go hand in hand with self-directing. Please make sure you're listening to both podcasts because they really go hand in hand.
Yeah. Well, thanks everybody for tuning in. Let us know if we can be resourced at Directed IRA. It's directedira.com. Mark said you can get the number there. You can schedule an appointment with one of our senior accountants to go over converting to Roth. And we're going to be back next week. Until then, stay calm, self-direct on.